Would you get on a train if it was going in the opposite direction you intended to travel? Or would you take a flight 10 hours in the wrong direction to then travel back 20 hours to get to your intended destination? Or would you teach your child to ride up a hill with the most resistance if it was their first time riding a bike? Now, I'm sure for the most of you, the answer is no to every single question. So my question is this: why do you trade against the trend and continue to look for reversals? Is it not better to trade in the path of less resistance than be the smart guy or lady and anticipate something before it's even developed? Now, for me personally, I would think so. So why do traders continue to trade against the trend? Well, what's the advantage of trading with the trend? Well, it's all about probabilities and finding an edge. Now, if the markets are trending down and you take a sell, you're more likely to have better odds of winning that trade and the edge that you're looking for because you've already identified the main consideration, which is identifying the direction of the markets. Now, if the markets are trending up and you take a buy, you already eliminate doubt, remove emotions because you are not guessing or anticipating, and you build confidence that the probability of you winning the trade is much higher because you're following the momentum of the markets. So you can increase your odds, give yourself an edge, build confidence in your setups, and have an advantage from a probability standpoint that you're going to be on the right side of momentum. Forgetting about reversals and anticipating the market's direction will be done away with. Now, for me, it is a no-brainer. Now, some of you might be asking, well, what happens if the markets reverse and I lose? Well, that just means you lost a trade. It's part of your business and it cannot be avoided. But what can be avoided is taking trades you shouldn't be taking in the first place. By doing this, you will naturally increase your win rate and decrease your losing rate. And all I can say on the matter is stick with the trends, and I can promise you that your numbers will start to play out. So we're going to take a look at an example here on the charts. I want you to see it for yourself. See what you think. Now, the example I'm going to show you is for illustrative purposes, so it doesn't mean that the markets are going to continually trend the way you want it to trend every single time. But what I can guarantee you is if you're patient enough, you don't do dumb things, you wait for the markets to talk to you before anticipating, then there is a much higher chance that one day, 1 week, 1 month, at some point this year, you'll be able to get into the right trades that you can maximize your wins and definitely help to decrease your losing rate. Let's take a look at the charts and see what you think. Okay, traders, so here is an example we're looking at on Pound USD. Now, for those that are skeptical out there, I just would ask you kindly, just exit off the video now. And there are many other traders and mentors out there that you can follow, that you don't have to worry about what I'm doing here, okay? If you are optimistic and you want to learn and trust the process, then look at the charts here and see this example for what it is. Here in this example, we can clearly see the trends are moving up. It's a no-brainer. How do we start this analysis? Well, looking from the left, we can clearly see here the structures of the market are clearly rangy. We have a break above this structure here indicating strong bullish sentiment. Now, in this range, we can see prices stepping up, making higher highs and higher lows. And I'm not saying this is a perfect entry or an ideal entry that you would take, but the point is, if you take an entry, you're on the right side of the market, higher highs and higher lows. The market continues to push up. What are you looking for the market to do? Create levels where it's failing to break below, indicating continued bullish sentiment, and then you go in for the trade again. Now, I don't care if you took a trade here and price triggered you in and you had your stop loss below the structure and you got stopped out, that's completely fine. You lose this trade, okay? But when you see another opportunity, you go in. Now, nothing here is indicating to us sells. Everything right now is indicating buys because we have the breakout, the consolidation, key levels being respected, and now we anticipate price to go up. Once price breaks structure, what are we looking for again? Well, we're looking for a tradable opportunity. We're looking for price to create a higher low in the market to indicate a push phase, a pullback, multiple wick rejections, and guess what? You're going for the trade again. Why? Because the momentum is up, the structure is up, price is breaking previous highs, and what we're looking for is patterns that will resemble double bottoms, higher lows, or retests of structures. So we take this trade. Again, the market continues to push up, breaking previous structure highs, coming back to these levels, and again, multiple wick rejections, you're going for the trade, and Bob's your uncle. Now, as you can probably see throughout this process, we're not overthinking, we're just identifying that the trend is up, we're waiting for price to break structural highs, we're looking for retests, wick rejections, engulfing candles, and we're going in for the trades. This is not about management right now, this is simply identifying the trend is up. So the market continues to push up. We break above these highs, we pull back into these levels as a retest, we get engulfing candles, we take the trade, buy. The markets continue to push up, create multiple wick rejections. Let's say we hit this with an instant execution, guess what? We lose this trade. Now along the way, let's say we lose 2 or 3 of them and we win 2 or 3 of them. Based on a good 1 to 3, 1 to 2 risk reward ratio, you're very profitable. But throughout the whole process of analyzing this, we were simply just looking for a couple of key concepts here and principles, and we were just hitting buys or taking buys when evidence and confirmation presented itself, and that was it. When do we start to change our bias? Well, the only time we change our bias, traders, is when the markets talk to us. For the whole duration, you probably can see here, price was trading above the brick wall, making high highs and higher lows, and most of you would have missed all of this movement because you're probably looking to the left and anticipating reversals, identifying wick rejections, looking for sells, looking for your supply and demand levels, and then by the time it's all over, guess what? You're like, what did I do? Now, when the markets start talking to you, start showing a behavioral pattern that is different to what you're supposed to see in an uptrend, i.e. breaking brick walls or structural lows, then what do? You just jump in the markets and hit sells. Look for your double top patterns. Look for price to break previous structural lows. Wait for price to come back to these levels. Hit sells. Let's say you lost this one. Whoop-de-doo, guys. It doesn't matter. Point is, I'm not having to think about anything else other than the simple fact now that the market is trending down, I'm looking for sells. You have a breakout here. Don't anticipate a reversal. Wait for the market to truly show that it's reversed. If it breaks out and breaks back in, hit sell. Keep going. The market's breaking previous structural lows. Hit sell. The market's breaking previous structural lows. Hit sell. The market's creating pullbacks, multiple wick rejections. Hit sell. The market's pushing down, creating multiple wick rejections. Hit sell. You're going to lose some of them. But again, what's the simple process? Just identifying price breaking lows, pulling back for retest, creating double tops, lower highs, multiple wick rejections, and only changing my bias if the market speaks to me. Now, if I'm identifying these levels here as my major key level, price is not breaking above it, and then price is coming back and creating levels that look like they're breaking above structures here, but not breaking high to make high highs and respecting that, guess what I'm doing? Hitting sells. And for the whole process, I'm not saying you would have taken all of these, but what I am saying is that you're keeping it simple. You're trading with the trend, you're hitting buys no matter what, making sure you have a safe stop loss, identifying your trades through wick rejections or whatever it is as part of your strategy, and only changing your bias when the trends are violated and price starts to create new lower lows and lower highs, and vice versa when price starts to create new higher highs and higher lows. This is how you will begin to become profitable, you'll become more confident, you'll start trading with the edge, working with probabilities and allowing the numbers to play out. So that was the example. Very simple, and if you stayed with me to the end, then probably you're more optimistic than a pessimist, because you might say, well, you've done this on replay, Rocks, but I'm telling you now, don't be a donut. Look at it for what it is, understand the principles and the concepts, apply it to your trading, and if we nip this in the bud, all I can say to you all is keep it simple and continue to trust the process. Like, subscribe, and turn on notifications. Until next time, bye-bye.